From the morning reading, stocks close about even. SEDG gaps up 28.1%. SCSS also gaps up and closes up 18.9%. FEYE gaps down 22.9%. SHAC trading up 5.6% in after-hours trading after a positive outlook. Three sectors moved higher on Thursday. XLF, XLY, and XLI were the strongest sectors, while XLU was the weakest sector. Breadth strengthened slightly as decliners led advances 1.05 to 1 on the New York Stock Exchange and 1.16 to 1 on the NASDAQ, where it weakened. The big tech heavy NASDAQ 100 has been hitting new highs, but too many stocks aren't coming along for the ride. When the index was hitting highs on Monday and Tuesday, barely 60% of the stocks in the index were even above their 200-day moving averages. That's one of the lowest readings in 14 years. Next to October 2007 and July 2015, which proved to be poor times to expect those new highs to hold. On a separate note, I understand that only about 55% of the S&P 500 are above their 200-day moving averages. As also noted yesterday, gold had declined 13 of 15 trading days, a rare level of selling persistence. It again dropped on Thursday, making it 14 out of 16 days. The last time that happened was never. That has never been this kind of concentrated selling pressure over a multi-week period. Hello, this is Stephen Harris, the head trader from Falcon Global, where we model best practices for investors, traders, and day traders from entry to exit every trading day. In this daily video, I provide my opinion and insights of current market trends, market timing, volatility, and hedge risk levels for the upcoming day for the key U.S. financial markets. It is 6:58 a.m. Central Time, and I'm recording this in preparation for the market day of November the 6th, 2015. Full disclaimers are at the end of the video, but be aware that this is for educational purposes only, and only you are responsible for the investing or trading decisions that you make. One quick note, I want to say thank you. We have gone over 100 subscribers on our YouTube channel, and we take that as validation that what we do here each morning before the market open with this market preview is providing valuable content to investors and traders, and that they find it of interest to take their time each day and spend a few minutes listening to this YouTube video and help them get ready for the day. So let's go ahead and dive in and see just what it is that all those subscribers were taking a look at. In terms of our morning report, all four of the broad market U.S. indices, they're essentially scratched. I mean, there's nothing in terms of movement either up or down there that separates from scratch enough to even note. Crude oil up about 0.5%, euro about scratch, bonds about scratch, and gold up about 1/3%. In overseas action, it's very mixed. China up 1.9%, Hong Kong down 0.8%, Japan up about 0.8%, and Europe, Germany essentially is just below scratch, as is the United Kingdom. With this kind of scratch flat overnight market, this is not terribly surprising. We have a very big macroeconomic report today, and that is the monthly employment rate. This has a lot to do with whether the Fed will likely change interest rates in this next month. So this is a biggie and will have a big impact not just on the trading and investment market for today, but also in terms of what is likely to happen in the weeks to come with the Fed impact. So that's the big one for today. In terms of other stuff, it's all related to the employment report. Don't see anything else. We do have FOMC member Brainard speaking after the market closes today. So that could give you some insight into how the Fed takes the employment report. So that could influence the Sunday night open of the futures market into Monday morning's trading activity. So kind of keep that in mind. Let's see here. Let's take a look at volatility. relatively benign. We're at short-term VIX 14.22. Skew continues to be elevated. IV percentiles 11 for the S&P, 20 for the Russell, 14 for the Nasdaq, 19 for the Dow. Relatively low levels there. No standard deviation moves were put in yesterday by any of the broad market indices, and you see we've actually started to age off some of that earlier volatility in 3 of the 4 indices, though the Russell still has quite a bit of volatility that it's presented itself with in this last 2 trading weeks. For the S&P, this is actually a little below normal. We normally expect to get about 2 single standard deviation moves per week, and so we're actually starting to be a little lower than normal there. In terms of, let's go to the charts now. So the SPX, obviously we've been running up against this upper area of the former range, and after putting in a whole series of bull flags, we started to have this reversal pattern, and that was confirmed with yesterday's action. So you had some people might call this a tweezer pattern. Some people might call it a bearish engulfing. I prefer to call it a bearish engulfing. But then that was then confirmed by this action yesterday. So this would seem to set us up for a bit of a retracement. As to whether that's the retracement or it goes further, we'll have to wait to see. If it goes further, and remember, this monthly unemployment report is likely to be the information that dictates where we go today. But if it's weak, where does it likely to go? It's likely to go, first of all, to about 207.9. And then the second line of support would be this area right here, about 205.8. Now keep in mind that either one of these can be slightly undercut during the course of the trading day, but we would think that if it's truly going to be support, that a close would be above 207.9 or 205.9 respectively. So that it might go to 207.5 to 205.50 on the SPX, certainly is in the realm of possibilities. So don't think that you can just put a stop, a couple pennies below that and think that it might hold. The algorithms would likely run those obvious stops just to have volume come back in and then take it to a higher close if indeed the bulls are going to hold. So kind of keep that in mind. A little bit of a pullback, but we are kind of phase 3. We'll go to the daily report in just a second. But the expectation is that these are going to be just bull flags, much like what we've seen here. Slight pullbacks, relatively shallow. And then on a continuation into a bullish trend, at least until we get to this resistance area of the former channel with the all-time highs that actually go back to May for the SPX. In terms of the Nasdaq, of course, it's been already setting all-time 52-week highs, and actually is coming into the all-time highs from some 14-15 years ago as well. So also reversal pattern here. Remember from the morning reading the comments about that weak breadth, we continue to take note about that. And then also on the Russell, another example of kind of lack of participation in an area where if we're really that much of a healthy bull, we should be getting more participation. Notice it stalled out at the former 2 months ago FOMC wick, and still continues to fight that level, and in relative terms continues to be well behind the S&P, the Nasdaq, and even the Dow. Dow much more like the S&P, up here near former highs, but also in this rollover pullback pattern on the candlesticks that we have seen in the other indices. Take a quick look at the volatility. VIX futures down here in the bullish area. Anything that's kind of between that 12 and 18 is kind of the typical bull market volatility. Nothing really rearing its head there at this time. Of course, bonds have been really taking it on the chin of late, and we'll likely see with the employment report today. This will be one of the big tells. Watching bonds and watching dollar futures /DX on the Thinkorswim platform, but notice this trading range that the dollar's been in, and we are tickling the very, very, very top of that. If we get a breakout with dollar going long, you'll likely see euro going down, yen going down, gold moving, broad market moving, bonds moving. This is a big tell right here, so keep an eye on the dollar futures. Let's go to our regular daily report. Indeed, we are phase 3, bull flags. In terms of our portfolio investor posture, we're looking at IBD status, confirmed uptrend, accumulation distribution on the S&P, a B, and scored a C on the NASDAQ, and that goes back to that weak breadth that we've been talking about. GMI index is a perfect 6 out of 6, so that buy signal has been in place since 1019, but that author remains in cash. And he's concerned about the this relationship between the key moving averages, and indeed our own primary market condition measure puts us as a neutral bear, despite the fact that things have started to improve across many of the time frames. In fact, if you look at the decision point scoreboards, we've been talking about how the short term and intermediate term are basically all universally green. We did have a change yesterday on the S&P 100. And remember, again, breadth. We've been seeing these kind of defensive stocks, those big caps with dividends. Those have been where people have been accumulating, not necessarily the more growth-oriented, smaller stocks. But we did get a long-term trend model signal on the S&P 100 yesterday going bullish. So this continues to heal the technical damage that we had from August. And as that improves, we may very well see, this GMI index author go to a heavier invested position as well. With the intermediate term market posture, that is very bullish posture with an upslope sentiment. So when you put the consensus of all this together, we remained in a transition with mixed time frames, but ultimately you have to say the bias goes heavily to the bulls at this time. In terms of that intermediate term market posture, we're very bullish across all 4 indices, and indeed you'll see now the Russell's now gone over a 90, so all 4 of these are up over 90, very, very strong, very bullish. In terms of position sizing opinions, both position sizing opinions still remain over the 75 to 100%, both systems going all in. In terms of hedge warning status, we remain at 0+, which is normal with some elevated risk aspects. And those elevated risk aspects have really become quite minimal. And indeed, if we see the S&P go to new 52-week highs, this will likely drop to just a normal 0 hedge warning status. So things are still looking very, very bullish, and the technical damage is just about healed. You notice that in the lower metrics, there's very little here of concern. We have the S&P with a distribution day count of 4. 5 would be a warning status, so that's close. That skew continues to be elevated, and you see that that has an 11.8% probability of a 2 standard deviation move within the next 30 days. In terms of the intermarket risk aversion indicators, all 5 are solidly risk on. And then also I'll mention the New York Stock Exchange yesterday, new highs, new lows, about almost 2 to 1, 271 new highs versus 188 new lows, maybe not 2 to 1. The thing is, it's not quite at a level of 300 in which we kind of make note of it, but certainly the bulls did dominate yesterday. I guess that's probably the fairest thing to say. In terms of special opinions, option income strategies, VIX is inside the acceptable window, so acceptable to initiate new positions by even novice traders. Cover call strategies, cautiously bullish, acceptable to initiate new positions. 1-to-1 ratio of out of the money, in the money strikes, so still somewhat defensive given the nature of where we are on the chart, pot odds are that we're likely to run into significant resistance. So be a bit defensive. Use a mix of in the money and out of the money strikes. Also use a mix of your higher beta versus lower beta positions. That will help keep you a bit more defensive and diversified as well. In those aggressive setups, consider using out of the money put selling and leg into the position size. And speaking of position size, keep that position size in the position size that you are willing to really own. And that'll keep you out of trouble in those unexpected pullbacks and corrections that are bound to occur over time. In terms of put selling, also cautiously bullish. Consider reduced position size and well out of the money puts if you have an aggressive setup, those higher beta kind of things that maybe you wouldn't be as excited about owning that stock. So kind of keep that in line. In terms of sector-specific performance, our market postures across the short, intermediate, into the long term is really pretty healthy. Greens across most of these setups. You notice consumer staples and utilities being the two weakest sectors, and then most of the sectors actually performing pretty well at this time. In terms of percent change, yesterday a bit of weakness, though financials, and we need financials to participate if we're going to have a healthy bull market. And consumer discretionary put in pretty solid days. And generally the weakness, with the exception of perhaps utilities and energy, was relatively mild. Those two sectors a little bit more, but of course energy's been very volatile and has been really on quite a hot streak of late, up almost 10% in the last one trading month. Okay, that should be enough for today. Again, we greatly appreciate the vote and of confidence and the acknowledgement. It's really remarkable how fast we've gotten to our first 100 subscribers on YouTube. Remember, that's a free subscription. There's no cost to that. And the other advantage to that is that you get noticed when new content is posted each morning, and you're able to jump right on that. So like us on YouTube. That helps us know that we're doing something well for our followers and it's being recognized. Also, other ways that you can acknowledge the efforts is to retweet us to your Twitter followers, to your StockTwit followers, and of course we also post to Scootify, basically the Facebook for traders and investors. Some special opportunities are available. More details about this course can be found at this website. Also, more details about Falcon Global can be found at this website. Disclaimers as always. Hit the pause button if you need more time to review this. And we look forward to seeing you back here Monday morning before the market opens with the Falcon Global Market Preview. Good trading.